In this conversation, we continue to talk about mutual fund mega trends, and I'm going to outline a few trends which definitely are important for us to think over, for us to internalize, and to come up with appropriate responses. The points that I'm going to make out relate to our own behavior in our own mutual fund portfolios. The first point is the concentration risk due to one single mutual fund scheme in a portfolio. When I came into mutual funds as a professional, I found that everybody was owning one particular scheme, which was a top 200 scheme. In every cycle, I have seen people over own a particular scheme. But there is a concentration risk to over owning one particular scheme, and we are going to discuss that with Subra. The second is excessive exposure to one particular style of investing. If you noticed, those who in 2018-19 went overboard with the growth style of investing and the buy at any price style of investing, even in mutual funds, have really had a rough time. Even now, that rough time continues to this day because they haven't performed as well as others who had a more balanced mutual fund portfolio. This can become very, very damaging if you have chosen themes with higher volatility. So that is the second mega trend that we are going to talk about, which is excessive exposure to one particular style. And when you do these two things, by extension, you bring in excessive exposure to a particular portfolio or fund manager. So these three are risks at different levels which get built in one over the other because of how we are fashioning our mutual fund portfolio. So let's talk about these three things. Subra first, excessive ownership of one particular scheme in a mutual fund portfolio. How do you see this?
See, we have all been saying that if you buy one mutual fund scheme, that is enough because that company, that fund may be holding 60, 70 shares. So you're diversified enough. Be that as it may, what happens is when you have excessive exposure to one fund, which means you're also having exposure to one asset management company and one particular style and one particular fund manager. If something were to happen to that fund manager, I mean either he leaves or death could happen, something like that, then there would be panic and there would be a lot of selling, etc. And you will not want all your money to be in one style of equity also. So it does not bother me that you have too much money in one fund, but the fact is you're not getting any other style. You're not getting, suppose you are in a flexi cap fund, then you're not getting perhaps enough of small cap, perhaps you're not getting enough of large cap, because you do not know what that fund manager at that point in time thinks about how much to put in large cap, mid cap and small cap. So a flexi cap can be your core, but it should not be such a huge percentage. I mean, I've seen people with 70, 75% or maybe even 90% in one scheme, and that to me looks risky. Also, there could be some FOMO which he develops, saying, oh my god, all of this is in one scheme, and now last 1 year it is not performing well, then what should I do? At that stage, what does he do?
No, they also have this tendency to buy other schemes of the same fund house which are twinning with this scheme.
Yeah, so there are two risks that you're talking about. One is the fund manager risk, individual fund manager risk. Second, the fund house risk.
No, actually there's a third one which I see as a bigger factor, which I've observed and I keep observing, especially in the do-it-yourself portfolios. There is a risk of having the same thing in different names, right? There are many fund managers who run multiple schemes who actually have the same shares in all their schemes.
Yeah.
Okay, that
Correct.
labeling is different.
Correct.
But the portfolio is the same.
Correct. Portfolio overlap.
Yeah, 80% is the same.
Correct.
So when you have three schemes like this, you are owning 50, 60, 70% of the portfolio in these three schemes. You are virtually owning the same stocks. in all the
Correct.
schemes.
Correct.
So you're not giving yourself an opportunity to buy other styles in your portfolio, which could be complementary to this manager style. Because sometimes if the particular manager is not doing well, then the other person will compensate.
Correct.
So this one portfolio fits all, or one portfolio manager fits all, or one investment style fits all, can become a potential risk.
Yes, and two, three things happen. If you have got 70% in a scheme and the scheme does well, chances are it will soon become 90% or 95% because other schemes are not
That's
doing well.
again a
That
problem
becomes
of
even
plenty
worse.
actually. You are
Yeah.
actually feeling happy, but you should be
You should
thinking
be
differently.
if you don't redeem at that stage, when will you redeem? Or fresh money should not go into that fund.
Now, I'll give you an
So
example. When I found that, let's say between 2023 and 2024, those 2 years, when I found that it was not really very appealing to invest in small cap, and mid cap was also trading above its historic valuation. So only large cap looked appealing to me. At that time, most of the investors were gravitating only towards one style of
style,
investing
correct.
and one category, which is flexi cap. Now, my problem with this is that eliminated them from buying precious metals, global. It eliminated them from buying other contra ideas like commodity funds, metal funds, funds with heavy natural resource and metal orientation. So when you rule yourself out of all the emerging themes, that's exactly what people did in 23 and 24, more in 24, and stuck to one category, one style, and in some instances, one manager. You leave out the one manager thing. One category, one style itself is bad enough actually to me. So they ruled themselves out of all the other things which could be complementary. And look what happened in 25 and 26. All the other things have done well. And this one category, one style has brought a lot of people to worry. It has not brought them to grief yet, but it has brought them to worry. Now, my perspective in this is, why should you make it so extreme? Why can't you always keep rebalancing? Because the principle of asset allocation and of having a multi-asset model in portfolio construction, which I totally believe in, is to give yourself opportunities to keep on mitigating the risk in your portfolio. Every episode of market volatility should be used to mitigate the risk. This is where the fundamental foundation of all this is laid upon. And on that you build a portfolio of mutual funds. This one category, one style approach, whether it's in small cap or flexi cap, or it doesn't matter actually, or even multi cap, it doesn't matter. But one category obsession basically makes the lack of diversity and portfolio diversification the biggest risk for the investor. My problem is not with the category or the style. It's definitely not with the managers or the manufacturers, which is a fund house. My problem is fundamentally with the risk management, because the investor has ownership over risk management, not the manager,
Correct.
not the fund house,
Not even the advisor.
not the advisor, not the category. Investor actually owns risk management.
Correct.
Advisor enables, facilitates the investor getting it right. So investor taking a very egoistic or a very extreme position on this is always going to bring the investor to grief or to worry or to insecurity. Okay, insecurity is the least, worry is more than that, and grief is the extreme. Today investors are bordering between worry and insecurity because of this extreme approach which they have taken. And this entire thing is sitting on the foundation or cement of past performance. Without past performance, this whole thing would never have happened. When you see a 24% 5-year performance, you are saying, I will go all into this, nothing else. I even had a client who told me, no, I'm going to put all my money. He took crores of rupees and put it in one product. So I said, there's nothing wrong with liking a product which is not ours or which we don't prescribe. But the risk management is so lacking for the kind of sum that is being invested. So today I see a lot of 6, 8 crore, 10 crore investments of investors, mostly under the DIY, having this problem. And this problem is not going away anytime soon. And in my view, this was a problem that should not have happened. It happened purely because of lack of adequate perspective and lack of respect for risk management. Now, if only the investor had thought about risk management, he would have had a little bit of gold, a little bit of silver, or he would have given the money to another multi-asset manager if he didn't know how to do all this. And all this should have been done in good time, not today. Today they are again making a double mistake. But it should have happened earlier. But this has not happened. But in every cycle, this is repeating, Subra. And now it's happening at a scale much higher than the past cycle. What are your thoughts on this?
So I agree with what you're saying. So even I have over last 5-6 years, maybe 7 years, suggested that multi-asset or BAF could be your core. With the increasing age, if you're 50-55, there is enough equity in MAF and BAF for you to get good returns. And in your this has to be your core. And even in your core, you like one particular multi-asset fund, it doesn't mean you have to be there, because when you check out 4 or 5 multi-asset funds, multi-assets also, there is one multi-asset fund which invests in equities abroad. There's one multi-asset which invests in more in Indian equities and Indian debt and gold, right? So you could get these
There is
combinations.
one multi-asset which invests more in only debt.
So you can getting a combination of one or two multi-asset, one or two BAF, that has to be your core. Then what you do in the periphery, in your satellite, you can
There you
play
can do your
around.
risk taking.
You do your risk taking there. But here, if you think one multi-asset fund is given you 28% and 26%, be prepared for 9% next year. Or you remove some money and put into some more aggressive multi-asset, and not in this, because he's already very aggressive. You put somewhere else. The problem with your risk, or realigning your portfolio to risk, is the advisor has to tell the client, I'm not trying to increase your return, I'm trying to reduce your risk. This nobody wants to listen to. At least they don't want to listen to before the event. After the event, they will still not say, or they will say, you didn't tell me forcefully enough, or something like that.
How can we be forceful on our investors?
True. So you say, look, I'm suggesting. So I remember talking to one person who had put in one fund, and it was becoming 70% of his portfolio. And it's a big portfolio. So 20 crore portfolio, and this was becoming 13-14 crores. He had put in maybe 1.5 crores. It has done extremely well.
On a little aside, in 2000, my friend had a portfolio of only software stocks.
Exactly.
And it was at that time a value today which is unimaginable in today's value, right? It was then itself a value which was unimaginable. I told him, you had it so good, can't you take 25% or 50% out and keep it aside for you to try some other style, or do something later. He actually scolded me at that time. He abused me. But that's not the joke. After 15 years, when I again pointed this out to him, I waited 15 years to point it out to him. He said, you should have beaten me.
Correct.
And made me do what is right.
Correct.
I said, you would have probably given a police complaint.
No, I remember, because when this
Because you are so aggressive at that time,
Correct.
not to listen at all.
Correct.
So the problem with people when they take a very extreme portfolio stance in their portfolio, especially those who do it themselves, the DIY guys, is that they are not willing to listen to anything.
No, but my story is, this guy was about 75-80% of his portfolio in one scheme. And then I said, it's too risky. Then he said, I don't want to name the fund manager. He said, is this fund house good? I said, yes. Is this fund manager good? I said, yes. So he said, why do you think there's too much concentration? Who told you? I said, that fund manager told me. Very rare for a fund manager to say, remove from my. He said, are you mad? Remove from my fund. I said, it's doing well, so he's not removing. So he says, you want me to do badly for him to remove? It sounds so odd. The fund manager is telling me to remove from his fund, and the client is saying, no, I like the fund manager. It's not about liking. It is too much for you. Right? That's what we are trying to tell you. We are trying to tell you that your food plate has to be a thali. You cannot say, I like gajar ka halwa, I will not eat anything, I'll eat only
Straight go
gajar
to the
ka
dessert
halwa.
counter
Yeah,
and
you
stand
can't.
only there.
You can't do that. It has to be a balanced diet is what we are trying to tell them. We are trying to tell them we are trying to reduce risk. This is not what they like. And I've seen this happening in people with ESOPs. They just don't listen. And I remember it. I mean, I can name HDFC Bank because last 3-4 years it's not done anything. And when I've been pleading with people, you've got 18,000 shares, you've got 74,000 shares. At least sell a bit.
Even when
They didn't
Aditya Puri
listen.
sold all his shares in one go, they didn't take cue
They
from that.
didn't bother. They said, oh, he's leaving the company, so he's selling, whatever it is. So, but people don't. And then they come to the rational, what difference does it make? I need only 2 crores. I have 18
But if
crores.
you
So
lose
that is
2 crores, you can't
rationalizing.
digest it, no?
Then they feel bad about it. Then they say, oh, I should have sold and all that. So I
No,
don't
that
know.
anyway, the subject of ESOP concentration is,
Yeah, but
it is content for another separate discussion. But the point is the principle is the same. See,
the
the same
principle is the
principle
same.
applies here also.
No, you can't be buying only shares of TCS, Tata Motors, Tata Steel, and all that. You're concentrated on Tata Group, right? You can't run that risk also. You want to run across groups,
No,
across geographies, everything. You need to
correct.
have a diversified.
No,
When you say diversified, I don't want all the money to be in one fund house also, in one fund style. I put here in value fund, here in value fund, here in value fund. It may be great, but look at the
actually,
portfolio. There'll be an overlap.
there's a very interesting thing that which comes up for review of a mutual fund distributor, especially if he has more than a particular percentage of exposure to one fund house. 50% is what they say. But investors comfortably have more than 50% in one fund house.
Yeah.
In
Not
my
just one fund house, in
in
their
one
favorite scheme.
correct.
You
Anyway,
can't ask them to remove money from their
or
favorite
one scheme
scheme.
and its cousins.
Yeah,
So that love for a particular scheme, style, category, fund house, all four, in my opinion, it requires a lot of remediation and moderation. Do you
no,
agree with that view?
what happens is they start with a small concentration, then that fund does extremely
They keep
well.
on adding into it.
They keep on adding, and the fund also does
Still
well.
does well.
So from 40-50%, it becomes 70-80%.
But
It's
let me
time to
phrase the
remove.
problem. It's a problem of plenty. It's a problem of success first.
Correct.
But when you have a problem of too much success, you have to actually deal with the problem. Because if you don't deal with the problem of excessive success, when you are seeing the success before you, you are going to deal with it later when the success starts waning
Correct.
or diminishing,
Correct.
or sometimes even starting to become failure.
Correct.
So it's always better to deal with the problem of too much success when you see the too much success before you reducing the risk, de-risking the portfolio by reallocating capital, by giving capital to more responsible managers, to more complementary
Different styles.
styles,
Yeah.
to more dependable houses, and creating an ecosystem inside your portfolio which is self-preserving and growing. That is the fundamental point that I want to be the takeaway from this video. Thank you, Subra, for this discussion. I am sure people will take an objective view, especially those DIY investors who have excessive exposure to one style, one product, one fund house. It could be just small cap, it could be flexi cap, it could be any category. Just be safe, because maintaining safety in your portfolio, managing the risks better, is the essential ingredient for your future success, especially from where the market is right now. Thank you very much, and thank you, Subra.
Thank you.